so much, everybody, for logging into our virtual event, the Stone and Chalk Capital Raising Guide launch. A bit of housekeeping before we start. Now, we understand how important it is to you all to have your questions answered on this important topic. So if you have any questions, please use the Q&A function on the bottom of the screen. There'll also be a short survey at the end. So we'd really appreciate if you can help us continue to improve our events, and please complete that. So we've had over 700 people registered for this event today. And I know that you aren't all residents of Stone and Chalk. So for those of you that are new to our virtual space, Stone and Chalk is a not-for-profit organization that was founded in FinTech in 2015. We exist to nurture, connect, and propel those who are seeking to solve the world's most pressing business and social challenges. We have a proven track record in understanding the key drivers for growth and commercialization for emerging tech sector startups and scale-ups. We specialize in selecting, connecting, and catalyzing 3 key stakeholder groups into one powerful impact network. So in this impact network, we have our founders in the emerging tech sectors, corporate, industry, and government partners, and a select group of mentors, subject matter experts, and investors. In this sense, our startups, partners, investors, and mentors are shaping the future together. Residents of Stone and Chalk have access to our collab package, which includes a full suite of growth and commercialization support. Our capital raise guide for startups that we're launching today is one important piece of that funding pathway, and we're super proud to be launching this guide, which aims to demystify the process, the pitfalls, and promises of capital raising to support you in making the best decision for your startup. I will now hand it over to Cheryl, who will be moderating the panel. Cheryl is our head of community and communications at Stone and Chalk. Prior to this, she was the CEO of StartCon, which she built from the ground up into an international events and entertainment company. She hosted the largest startup event in Australia with over 4,000 attendees and speakers from tech companies like Uber, Pinterest, SurveyMonkey, etc. She's also hosted the largest pitch competition in APAC with events in over 15 cities and a $1 million prize. Through this, she's helped thousands of startups secure funding, customers, and partners. Over to you, Cheryl.
Amazing. Thank you so much, Annie, for that awesome intro. I'm super excited that we have gotten to today, the day of our launch of this guide. And we have an amazing panel with us. I'm going to go through their intros pretty quickly. Unfortunately, guys, I'm not going to give you as good of an intro as Annie gave me, but you're going to hear so much amazing advice from these guys today, so I think you'll forgive me. So today we have Simon Cant, who is the co-founder and managing partner of Reinventure, which is a $150 million fund, which has Westpac as its primary investor. We also have Michael Dovey, who is a general partner of IAG Firemark Ventures, and they are the strategic corporate venture capital fund of IAG. We also have Andrea Gardiner, who is the CEO of Jelix Ventures. They do investor-led syndicate investments into early-stage Australian tech startups. And lastly, we have Quirk, who is the investment manager at Rampersand, a venture fund which backs founders at the seed investment stage. So we have a wide variety of investors here today, and we chose these 4 specifically because they are so different, so that they can give you basically an overview of the differences between options, because there are lots. So I also just want to mention we got over 50 attendee questions, so we won't be able to get to all of them today, but we will be doing a mini series and working with our partners, such as the speakers that are here today, to answer as many as we can after this and following on in different video series. So let's get started with different structures. Mike, can you tell us what is a corporate venture capital fund and how does it differ from a regular venture capital?
Sure. So IAG Firemark Ventures is a corporate venture capital fund. Basically, all that means is that you're a fund dedicated to a corporate enterprise. So IAG is the largest general insurance company in Australia that owns brands like NRMA and CGU. We created the fund in order to invest strategically on behalf of IAG to try and identify opportunities that we thought would be important to the future of our business and the future of insurance more generally. So the only real difference, I suppose, between a corporate venture fund and a traditional venture fund is really in the structure and in the rationale for why you exist and what you're investing in. So we invest strategically for IAG. Of course, we want to make good financial investments as well. So it's not about dumb money. And in fact, you don't get any strategic benefit if you're investing in companies that don't go well. So the two do go hand in hand. But the first lens we look at opportunities through is a strategic lens first and foremost. Whereas a traditional financial VC fund might be a little bit more open to purely just looking for opportunities that make sense financially.
Excellent. And Simon, Reinventure is kind of considered a corporate venture capital fund, but I understand there's some slight differences. Can you explain, and what does this mean for founders?
Yeah, so thanks, Cheryl. We're set up with a traditional venture fund structure. So we're set up under the Venture Capital Act, and the management company is separate from Westpac. That was an intentional structure when we set the fund up, because there are some challenges sometimes that we've experienced operating corporate venture funds in the past, where sometimes your objectives of the venture and the objectives of the corporate may at some level come into conflict. And sometimes you'll see that in the case, for example, of where a corporate is keen to sort of have some level of exclusivity or something like that. So we, because we're set up as a separate, I guess, entity, or set up with that traditional venture fund structure, we're a financial investor primarily. And we act as both a bridge and a buffer to Westpac, I guess, is the idea. And our interest, because we're on a standard kind of carried interest type model, which is similar to the way a normal venture fund works, which is that we only get paid when the founders get an exit. That means that our incentives are very much aligned with the entrepreneur. So we, as I said, we can act as both a bridge to Westpac, but also a buffer where their interests may come into conflict with those of the entrepreneur.
Awesome. Thank you, Simon. And Andrea, you have a different model as well. So could you explain the concept of an angel syndicate? How does it work, and what are the benefits?
So investing really early stage in tech startups, especially pre-revenue, before the business model's been proven, or anything else has been proven really, is pretty high risk. And it's, the bigger funds have to write, you have a kind of 4 to 6 boards that each partner has to go on. So the bigger the fund, the bigger the check they have to write. Generally, I mean, I'm overgeneralizing, but I think that's generally true. And then when it comes to the very early stage startups, like pre and very early revenue, it is high risk. So what the usual source of funding is a group of angel investors, not people that will write a check for the whole round, but they'll write a small check to take part of lots of different rounds and build a diverse portfolio that way. Statistically, angel investors need to invest in about 22 minimum startups over about a 2-year period to sort of hopefully mitigate the risk of overall portfolio loss and place them in a decent position to get a strong return. So a syndicate is a group of investors that share an investment round and in aggregate write a check for a certain amount of money, but the different participations can be very different numbers. Our business, Jelix Ventures, what we do is we source and vet deals, and those that we decide that we're going to invest our own money in, and that's actually myself and my husband. Then we invite, we send an email, an invitation to our investors. We have I think we've got well over 600 registered investors, and I think about 80 are really active and repeated, invest quite often with us, and invite them to participate in the round on the same terms as us. And our model is quite different. It's an investor-led syndicate, and we don't charge the startups like an equity crowdfunding platform, but other than that, it works a lot like that, I suppose. We don't deal with retail investors. We just because of the financial services licensing, and I suppose there's a bit of a concern about the sophistication of retail investors as well, investing in such a high risk asset. And we take a fee that's structured similar to a fee for a venture capital fund. It's a bit lower across the board. And that's the way we work. So we've done, I think it's 21 investments in 14 startups now.
Awesome. That's fantastic. I've seen a couple of your investments as well. So yeah, very excited about that. Chris, Rampersand will be considered the kind of typical VC model. Can you explain how that works and what kind of deals do you typically do?
Sure. We have a number of limited partners, LPs, who we take their money and invest it on their behalf in early stage companies, with the expectation that we can get them a higher return to compensate them for the risk that they're taking going into an early stage venture. I guess where it differs from an angel syndicate is that we are doing it without their input each time. They obviously have their input right at the start, and then we have a fund which lasts typically 10 years, and we will deploy their capital and then help cultivate the capital and hopefully exit some of the capital and then give it back to them at the end of the 10 years, instead of each decision being at that investor's choice like an angel syndicate. Rampersand has close to 100 limited partners, and I guess where that differs from the corporate venture funds is, we have 100 limited partners as opposed to one or maybe two major investors in there. And the typical deals that Rampersand does is seed investment, which is about $150K to $1 million in terms of a first investment. We'll often follow on a number of times. I think $10 million is about the most we put into a single company. So that first investment is definitely not the whole investment. And then we look for tech companies as a lot of VCs do, because they tend to scale a lot better. Probably not as early as angel investors. We might touch on we will touch on pre-revenue. We may touch on pre-product, but that would have to be quite an exceptional situation to do that.
Interesting. So it's interesting that you kind of mentioned the differences there, because that kind of leads us into our next set of questions, which is really around the differences between the criteria that you have and ideal kind of situations for, I guess, approaching you really. So this question is for all of you, so I will go one at a time. When is the ideal time for startups to get in touch with you or your fund for investment, and how early is too early? Mike, let's start with you.
So I think there's a bit of nuance in how to go about this. So I would say it's never too early to get in touch with us, but just find the right pathway to make that connection. So the mistake that I think a lot of founders make is the spray and pray approach, almost like spam, effectively. So don't send a mass email to every contact in your contact list, or a generic email list of every investor that you've got in touch with, presenting your startup. That's not the way to do it. You'd be amazed at how many founders and startups actually still do that, or just really cold generic messages through LinkedIn. That's not the approach I would endorse. Probably the best way to get in touch with us is through a mutual connection. So we have a website, we have our portfolio companies listed on the website. Perhaps it would be helpful for the founder to make a connection with one of our portfolio companies and use that as a pathway to then build a relationship with us. So do a bit of due diligence on us first and foremost, figure out what we do, what we invest in, who we are, and then leverage a mutual connection to make that contact. And even if it's early, that's okay. We're happy to get in touch and understand what you're building and start to know you as a founder quite early in the piece. In fact, I'd say almost every company we've invested in, we've gone through a rather long process of getting to know the founders and vetting the connection that they use to get to us as well. So most of our investments have come through referrals of other funds that we trust. And it's just a really, really important aspect of building those relationships and starting that capital raise process. So it's never too early, but then when you're ready to go and you're ready to get your capital raise off, what we would expect is that hopefully, and with the help of this Stone and Chalk guide, hopefully you have all your ducks lined up and you know exactly what you're doing, and you have a data room in place. You have a structure around the fundraise. You know how much you're raising. You have a valuation in mind. You're ready to go. So yeah, that would be my advice. Start early, build the relationships, and then when you're ready to pull the trigger and start the capital raise process, that's when you really go for it.
And you're absolutely right, Mike. We do help founders move through that process to become what we call investor ready. Simon, would you say the same thing? Is too early for you? What do you like to see before a founder approaches you?
Yeah, I mean, we have done investments into ideas, actually. I mean, the earliest investment we did was, a founder gets off the airplane, has an idea that is a variant on something they've seen in another market, and we back them into it. That being said, that was a repeat founder who we knew very well. They'd had a solid exit previously. So it is a kind of case-by-case situation. I think for founders who are first-time founders, you do need to see a bit of traction first. I'd agree with most of with all the comments Mike made, actually. I think it's never really too early to get in touch, but I think the way you get in touch is important. For us, absolutely, existing portfolio companies or existing connections are the best way to make contact with us. Something that I've seen work extremely well is when founders will get other founders who are further along the journey onto an advisory board or in some other capacity to sort of support them in that journey, so that they build a real kind of sense of trust with that person. That person will be a great door opener for them into the funds that they're already invested in. So I think it's absolutely a very good idea to try and work with other founders who are just a bit further ahead in the journey than you. We wouldn't usually invest in a first-time founder until we have actually seen some revenue. So we won't usually do a pre-revenue investment into a first-time founder. And, can be a small amount of revenue, doesn't need to be over sort of 50K even, or even 20K in some cases. But we'd like to see a little bit so that we can start to see a repeatable economic model there. The only other thing I would just say, I guess, in terms of getting in touch, there's quite a few advisory firms around. And one of the mistakes I've seen is founders who decide that capital raising is something to be outsourced, and so they get an advisor involved. And I would absolutely suggest do not do that. There are a lot of VC funds who won't even take a look at a pitch from an advisor firm. And part of the theory there is that, if I back you as a founder, I need to be confident that you can raise the next round of capital. Now, if the last round was raised by an advisor, I have no confidence that you'll be able to raise the next round on your own. So it's really quite important. Advisors are great when you're looking for an exit because that's a one-off experience. Doesn't need to be repeated multiple times, but raising capital does. And we need to see founders who are good at raising capital. That's one of the key things we're looking for when we back them.
That's really interesting. Thank you, Simon, for sharing that. Andrea, you play in the very early stage space, so I'm guessing there isn't so much of a too early for you, but what do you like to see? What are your preferences?
Well, first of all, I'd absolutely endorse what Simon was saying. If we get flooded with capital raisers hitting us up and we don't even look at them, we basically send a quick email back saying we do not, as policy, invest where in a small round, a capital raiser is going to take a clip of the ticket that should be actually going to helping accelerate the growth of the company. So we don't do that. And I agree with Simon. We want to see people that can raise themselves. And I also think that the best person to sell the investment opportunity is going to be the founder. They're the ones that understand the space and are genuine and passionate about what they're doing. Hopefully they are. Probably wouldn't be interested otherwise. And I think secondary people just cannot do as good a job of selling it. So I agree wholeheartedly with Simon that it looks like a tempting shortcut, but I don't think it is. And the other thing is I really agree with Mike about doing your research. There's nothing to, I think the quality rather than quantity of your investor connections is vastly more important. That is really important. And, those soft introductions are really powerful. We increasingly get introductions from our portfolio founders, and they're really great quality intros. And, even if we don't like the first glance at it, we'll actually look further, because people like that, whose views we respect, we will really have a good look at them. So I think there's absolutely nothing to replace doing some research, making sure, if you can't find someone to make an introduction, then do your research, make sure you understand the model. Like for us, it doesn't look good if they come to us and they don't understand that we don't, you know, the model that we work with, and the sort of investments that we make. You know, we don't invest in companies that originate in Pakistan or China. We only invest in companies that originate in Australia or New Zealand, you know, and don't waste busy people's time if there's not a reasonable chance of a fit. And, you know, do things like work out what it is, and maybe, you know, I see you've invested in something or other else and we're doing, you know, I don't know, but just make it look like you actually have done some homework.
Yeah, absolutely. And Chris, early stage, what do you typically like to see, and do you have similar preferences?
Yeah, I would like to add a slight nuance to what Simon and Mike said, is that it is never too early to get in touch, and I agree with that wholeheartedly. But I think it needs to be split between stage of the company and when you're getting in touch before you're raised. Often, you know, we talk to people. The outcome is, I'm sorry, the traction's not there, or you are a little too early. That's very much the stage of the company. But the, you know, getting in touch as early as possible allows us to spend time, get to know you, see how you solve problems. And then when you do, as Mike says, when you pull the trigger, it's a much smoother process. But the stage of the company can still be too early. It's the getting in touch before your capital raise that we're very specific about with, you know, it's never too early for that. In fact, if you haven't been in touch with a VC and you are trying to raise immediately, and that's probably too late, not too early. So I feel that there's some confusion there with that and some of the feedback that we get.
Yeah, absolutely. No, I think that is really helpful. Speaking of early versus later. Oh,
actually, yeah. I might just add to that. You know, we invest much earlier than anyone else on the panel, and even for us, most of the founders we end up investing in, you know, we've known them for a year or more. We've just sort of seen them at a pitch event, or someone's made an intro. You know, we've provided a little bit of advice or a little bit of you know, a bit of coaching or whatever, and we just, you know, the best due diligence in some ways is tracking performance and seeing what it, you know, how they track. So early is good.
And Andrea, what do you think the pros and cons are of raising money early versus bootstrapping and waiting a bit later?
Look, the obvious, I honestly, I think that if you can bootstrap for a while, that's great, because, you know, otherwise you get, you know, you get heavily diluted, and obviously founders don't want that. And there's a balance between, you know, for investors, they want to make sure that that there's enough capacity for dilution for several rounds going forward to ensure that the founders are going to continue to be incentivized. But it's a difficult. I think there's not a clear-cut answer to the question, because I don't think you can generalize. I think it's very different according to the company, the stage they're at, the founders, the situation they're in, all that sort of stuff. But essentially, I think bootstrap for as long as you can, but you've got to balance that with maybe you need to actually take capital earlier so that you can accelerate your growth, because otherwise you might miss that wave and end up growing too slowly, and that will really hurt your business big time as well. So you just, it is a bit, yeah, it's a bit of a balancing act. It really is. And you know, like a lot of people, it's very popular to say raise more money than you think you'll need. And I do agree that you need to make sure you've got a really big buffer. But it's really hard for really early startups to sort of cop some of the significant dilution. And it's difficult. And sometimes I suggest, look, you could split it, you know, do sort of over a couple of rounds and, you know, show some growth, make sure that you're raising enough to get that next valuation inflection point with a buffer, and then raise more at a bigger valuation. So hopefully overall that your dilution isn't too unpalatable, but that's a risky way to go too.
Mm. So I think it sounds like
run out of capital, because running out of capital is death if you haven't got revenue.
Yeah, it's the valley of death, right?
Yeah.
I mean, if I can just add a couple of things. I mean, I think there's some great strengths that come from bootstrapping. You know, learning how to earn more than you spend seems to be a remarkable skill, and it's one of those skills that you can learn too late sometimes. If your company is always just built on capital raising. So, you know, there's real power to learning that early. But, you know, all of the points that Andrea makes about allowing things to go on for too long, growing too slowly, obviously also can be an issue. And particularly if you're in a competitive space where there are likely to be followers or others coming into that space, you need to take the opportunity while it's there and take the capital while it's there. So often we'll see these startups where, you know, it becomes a space that everyone's gone, that's an interesting space. And suddenly it's gone from, you know, hard to raise capital to this kind of war of cash where different startups are raising larger amounts of money to go after certain opportunities. So, yeah, it is it is sort of space by space, case by case. But there are a bunch of things that founders should educate themselves on as to, is this the sort of thing I should be doing? Should I be bootstrapping, or should I be going hard and raising capital early?
Yeah.
And I'd like for everyone to get a sense of different processes that they might go through at different stages of raising capital. So Mike, can you give us a little bit of an overview of like, what is the process that a founder would go through if they were to get investment from you?
So we probably spend 6 months getting to know the founder. This sort of touches on what I referred to earlier about building those relationships early. So we would hope to know the founder, know what their business is before they even start that capital raise process. So that's sort of be step one. Once the capital raise is ready to commence, we try to move as quickly as any other investor, despite being a corporate. So we've tried to streamline our processes to enable us to keep pace with all the other investors in the round, and obviously you know, move as quickly as that startup in that process as well. So typically we're a co-investor in funding rounds. So what that means is normally there would be a lead investor in place, which might be a typical financial VC, but it might be Reinventure, for example, or it could be Rampersand, or someone else that would more commonly lead a funding round. And that means that there's a term sheet that's in place, that's been agreed with, the valuation that's been set, and there's probably already been a certain amount of due diligence done on the company as well. Us as a strategic investor, what it means is, well, obviously first we have to be happy with the term sheet and accepting of those terms as well to come in on the back of that. But then it gives us a bit more scope to focus on what that strategic opportunity looks like for IAG as well, and how we might be able to create a win-win situation where hopefully we can support our portfolio companies by giving them access to data, or access to our customers, or access to our brand, or whatever other strategic asset we might be able to use to support the portfolio company. But then as well, hopefully we can leverage that startup in some way as well. So it might be us using the startup commercially, it might be a joint venture opportunity, or a data opportunity, or something else that we think is going to be mutually beneficial. So we actually spend a fair bit of time working through that process and making sure that we're a good strategic fit with that win-win really clearly aligned. And then we still, of course, move through the standard due diligence process that we would go through, but it's a bit more streamlined for us, just given the fact that we would typically co-invest and not lead a funding round. But start to finish, hopefully it's about a 6-week process.
Okay, perfect. That's what I was going to ask. So maybe Chris, could you give us a bit of an overview of your investment process, and ending with an estimated time?
Sure. Like Mike, we try try to make it as quick as possible, but are probably not going to be as fast as angels, unfortunately, no matter how hard we try. The informal part at the start, getting to know a founder, that could be 12 months, 6 months, however long that happens to be. But once they actually kick off the formal process, we'll likely do a formal pitch meeting with them. Then we will go away as an investment team and write down a set of hypotheses of what we need to believe for this to be a good investment. Then we will use those in order to interrogate the startup. We will potentially have a number of workshops with them to dig into areas where we have some doubt or have some questions or would just like some clarification. And then we will write a report. Report makes it sound really long. It's a couple of pages of why we think it's a really good investment, and we will take that to the investment committee. The investment team will take that to the investment committee. We will debate startup investors. Are both sides being represented? Is it fair what we want to do? And then we will move on to a term sheet. And I want to say 4 weeks, but probably 6 weeks is more accurate as well. Same as mine.
All right, fair enough. Simon, what about you?
Look, fairly similar process. So, what Chris talked about, that sort of process is what we'd usually kind of regard as our commercial due diligence stage. And to be honest, that's the part that can probably be most variable, because it's the part where we're working out whether we've really fallen in love with this venture or not. And sometimes that's a long getting to know process, and sometimes that's a fall in love fast and just sort of run down the aisle together process. It really varies company by company. During that process, there's a lot of us really digging into the model. One thing, just more point I would make, and this hasn't come up yet, so I just think it's worth saying, the occasional founder will ask for an NDA before they share their pitch deck, and we'll never give one. And we usually kind of regard that as, okay, they haven't really done this before. It's a fairly good sign that they haven't done this before. There is an okay time to ask for an NDA. Sometimes we'll say it's once we've actually signed a term sheet, but the reality is if we really start digging into the data, which we usually will do during the commercial due diligence phase, if there is data to be dug into, and that comes to the difference between kind of pre-revenue ventures where there is no data, and ventures where there's existing revenue and existing economic model. Where there is existing revenue, we will usually want to dig into the data before we sign a term sheet. And so we would probably sign an NDA during the course of that. The additional component, which is probably a bit more similar then to Mike, that we'd add is we will probably introduce them to somebody at Westpac at some point to try and get a feel for, is this something that could be relevant, interesting for Westpac? But after that, so that phase, can be a couple of weeks, can be 4 weeks. After that, we'll go into sort of long forms and legal due diligence. That's a more contained process, and we hope to get that done in kind of 3 to 4 weeks. It can get blown out if you have an existing set of investors and a whole bunch of weird stuff in your existing shareholders agreement and all of that sort of thing. So, it probably comes to a point we'll be talking about later as to what sort of terms to watch out for. But, if you can, there are a bunch of vanilla documentation sets out there. I think they're referred to in the capital raising guide. Avcal published them. To the extent that you can stick to pretty standard fundraising model, then you'll enable that process to move fairly quickly.
Excellent. And yes, we do have a question around what are some of the terms that we should expect. So Andrea, maybe do you want to touch a little bit on your process and then jump into what are some of the terms that founders should expect?
Sure. Just following on from what Simon said, we invest probably quite a lot earlier than everyone else in the panel. And the biggest thing that can gobble legal fees and gobble time is to have a combination of founders that haven't been there before and haven't done their homework on getting up the learning curve on what the basic sort of standard terms mean for them, and the potential ramifications for them, and in my view, inadvisedly rely on their lawyer to think about all those things for them. I think they need to think about them, understand them themselves, and the combination with a lawyer that isn't experienced in these sorts of deals, that can be, that can just blow the legal fees out. Even if it's a cheaper lawyer, I think sometimes it's better to pay more for someone that knows what they're doing. So our process is a little different. Because we're investing so early, often pre-revenue or at least very early revenue, the caliber of the founder it's always important, but at our end of the curve, our end of the kind of life cycle of a company, it's really critical. And ultimately, we're really investing in the founder, because there's going to be so many ups and downs and curves and twists in the path along the way. We need to have confidence that they're going to see the opportunities on the way and do all that sort of changing direction that's going to be required. So we need to get to know the founder and feel confident that these are people of integrity and, sort of sufficient intellectual firepower to take advantage of learning opportunities without those sort of emotional impediments that some people have to learning. So a really voracious appetite for learning, is one of the things we look for. And people we like, someone that we think we're going to enjoy working with. So going back to, that's kind of what we're looking for. But the process, I suppose, is getting to know the founder, what they're doing, what's motivating them, and looking at if we think after we've seen the pitch and met the founder and talked to them that it kind of checks our investment criteria, then we'll have a pretty high level conversation about some basic things like valuations, because, we sometimes have pre-revenue founders coming to us with crazy expectations on valuations. And, we just don't want to waste our time by doing lots of due diligence and we're too far apart. So we'll just have a very high level conversation about that. We'll dive into the commercial due diligence, but that is limited by the fact that there's often no or very little revenue. But we do a lot of customer calls or potential customer calls, that sort of thing, to try and work out the strength of that product market fit. And then, we agree terms. We, as a team, we agree that we want to go ahead with it. And then for us, the additional arm in all this is, once we've agreed terms, then we draft what is probably similar to an IC report, but it's we call it our offer document that we send out to our registered investors, inviting them to a private pitch and Q&A with the founders. And then we build that book, round up the syndicate and complete the due diligence, and the legal due diligence would be done before that. But complete the documentation, and we put the syndicate through a nominee structure that we have, so that the startups just have one entity on the cap table, so that to kind of minimize those problems with the next, VC, like Simon was suggesting, sometimes there's a lot of cap table cleaning up to be done. So we don't want to be contributing to that.
Actually, speaking of that, we did have a question from the audience. So maybe this is one for Simon or Chris. What are your thoughts around founders getting angel investment early on? How do you view early angel investments as a VC?
Positively. I think angels add a lot to a venture. They, often they'll work pretty closely with the founder to really help them through some of that early learning curve, which is pretty intensive. So yeah, we're absolutely encouraged by angel investors. We have angel investor. There's angel investors and angel investors. So, we've definitely come across companies where the angel investors are a problem. And sometimes that will be, as Andrew alluded to, there's, 50 people already on the cap table and already you have to be a public company or something like that. Yeah. Or sometimes you'll get angel investors who are kind of out of the financial markets and, you know, are all about cutting the sharpest deal that they can cut. And then you've got this founder who doesn't have enough of their own company left, or you might have all of these funky warrants or something that mean that the valuation is X, but the real, you know, pre-money valuation is something different from that. And, you know, it makes the cap table a bit of a mess because there's different instruments in it. So, you know, I think ideally you're working with angels who have done investments in the startup space before. They've got a real track record with it. And they're great in angels to get on board.
Awesome. Thanks so much. That's great. Chris, maybe you could share a bit about what are some typical terms that a founder might see in a term sheet, and on the flip side, what should founders look out for?
Sure. Some of the typical terms that a founder will find are obviously the investment and the valuation. The investment, we really like to be tied to, you know, what are you going to do with it? So I guess that's kind of discussed off the term sheet. The valuation, the companies are often very early, so a typical financial way to find a valuation is unlikely to be used. So we often just back solve from, you know, the investment is X, and we believe that the founders at this stage should dilute 10 to 20%, which is usually what we do. Then we back solve the valuation in order to get that done, because if there's, you know, if there's potentially no product and no revenue, you certainly can't build a financial model in order to figure out that valuation. And then moving on to some of the terms, you know, there's probably going to be some liquidation preferences, which are if the company does fold, whereabouts do the investors sit in terms of preference of getting money back first. Debt usually sits above equity, but the equity can also be stacked in an order of preference. So if there is no debt and half of the investment comes back, then the investor, if they have a liquidity preference, will probably get that before the founder. And there's also anti-dilution, which that can be done a number of ways. A full ratchet anti-dilution is often considered harsh on the founders at the moment, and that is that if you do a down round later on, you give up some of your ownership percentage to the investors in order to top them up to compensate them for the fact that the investment is now worth less than when they invested. Or there's what's known as a weighted average, where it's not quite the full amount, but it is some amount, which obviously helps the investors out at the expense of the founder. Then there's also tag and drag rights are another common one, which basically mean if you know, sort of 90%, 80%, it depends on the contract, of the company wants to sell, then the remaining 10 or 20% have to sell in terms of a drag along. Or in terms of a tag along, it means that if 80% are selling, then the other 20% can just tap in and also go at exactly the same price. It's usually used to keep the capital together, as opposed to having different people selling different amounts of secondaries at different times. But they're sort of the big ones that are in the table. The ones to watch out for are probably how severe the anti-dilution are. And then actually one I didn't mention, how many board seats the investors want. Some investors will require a board seat, others will not be quite as strict. Rampersand, we can go either way.
Mike, are there, oh yeah, go.
I was going to suggest, because those are, you know, great points by Chris, and there's actually a really good book by a US venture capital investor, a guy named Brad Feld. So Feld is F-E-L-D, and the book is called Venture Deals. It's got a subtitle on it. I think it's Be Smarter Than Your Lawyer and Your Venture Capitalist, or something to that effect. But if you Google Brad Feld Venture Deals, it is a really good book to guide any founder through the term sheet process. And it goes into a lot of detail with all of those specifics that Chris just talked through as well. And it gives examples, and it talks about what's in the founder's best interest in each particular example. So for anyone that's dialed into this session today, if you're thinking of raising capital, I would definitely recommend getting that book. You can get it as an ebook, or you can get it on Audible or whatever. But you'll be doing yourself a big favor, and you'll make the process a lot easier as well.
Can I just jump in there? I think that's a great book, and it's really basic homework. But I would start, if it was me, with this one. Can you see it? So that's The Secrets of Sand Hill Road by Scott Cooper. It covers a lot that's similar to Bradfeld's Venture Deals, but it's a really quick, easy, palatable read. If you're totally unfamiliar with, venture deals, then and the terms and things, I think that's an easy place to start. Read that first, then read Venture Deals, and make sure you understand it. That's my suggestion anyway.
Awesome. I've taken a note of those books as well, so maybe we'll include them in our follow-up email so you guys can find those books. Definitely recommend doing your research. So we have a couple questions here around your fund's average check size and what range of equity a founder should expect for that amount. So if you feel comfortable sharing that, I think the audience would love to hear from each of you. Andrea?
Look, our check sizes sort of range from as little as 250 to about I think it was about 1.5 or something was the biggest one we've done. So they range pretty wildly. I think our sweet spot's around $500,000. And the valuations also range pretty wildly. If it's pre-revenue, very early revenue, and it's a really experienced founder that's been there and done that, like Tim Power with Inquisitive, he'd already built Mathletics to a $330 million listed company. So, he got a bit of a premium valuation, over say, a first time 26-year-old founder. I can't tell you what percentage, because at the moment, look, we like between sort of 10 and 20, but it just depends on the val at the time. And we don't have fund economics to deal with. So at the moment we don't, although we're just about to recommence raising our fund, having started early this year and then paused for the pandemic. Then we will have to worry about fund economics.
Okay. Chris, maybe you can explain fund economics and give us your average check size as well as the equity amount founders can expect.
Sure. I might start with the second one because it's significantly easier. Our average check size is 150,000 to $1 million. Sorry, it's not average. That's our span. And for that, we would usually expect to see somewhere between 10 and 20% dilution in the round. We may not take that whole round, so we wouldn't often expect 20% just for us, but over the entire round. And then we also, our maximum valuation is around $20 million for a company. It starts getting too expensive once we go over that. And in terms of fund management and the economics around that, I guess the best way to explain that is often VC funds will aim for around a 3 times return to their investors. It can vary around that. So if you invest in 10 companies and you get a 3x return on all of them, that's awesome. You've made your 3 times return for your fund, excluding the carry. So maybe you actually need to make a 3.2 times return on the fund if you want to return 3 times to your investors. But given that startups are such a risky thing, 10 out of 10 of your investments are not going to survive. So if even one of them drops off, you're not at your 3 times return to investors. And then when 1 out of 10 of them survive, you really need that one to return. So if you have a $10 million fund, you're looking to return $30 million to your investors, you need that one startup that is going to survive to return $30 million from your initial investment, which might only be 500K or 300K. So the fund economics or portfolio construction is how do you decide who you're going to invest in terms of, are they going to be giant companies or are they going to be a number of probably slightly more successful smaller companies in order to construct a portfolio that at the end of the day, once you've looked at the risk and the high rate of failure of startups, it gives you that 3 times or 3.2 times return. And I guess that is each VC's secret sauce of how they construct their portfolio.
Fair enough. Simon, what average check size, typical equity?
Yeah, I mean, it's hard to talk about average, but our first checks have ranged from sort of 300 to 4 million. And the mean check size would probably be around about the million mark. That's probably our most common check size. Fund economics. In terms of fund economics, I mean, I think Chris has kind of addressed the core of it. I think it's worth bearing in mind that different funds do take different approaches to what they're looking for. So some funds are looking for what you might think of as sort of solid 1s and 2s. Now they'll still want to make a version of their sort of 10x on that, of those 1s and 2s, but they might be prepared to be more in the 5 to 10x range. They might expect 50% of their bets to pay out, or maybe even 70% of their bets to pay off. But they won't be looking for complete moonshots. They'll be looking for solid returners. And then there are other funds that are really looking for moonshots. You know, they're looking for something where, and usually this will come down to what VCs call TAM, or total addressable market. So, you know, with moonshots, you're often looking for something that's global in nature, you know, a multi-billion dollar market. And probably only 1 in 10 of them actually pay off. But if it does, it'll literally pay back the entire fund and give all the returns for the entire fund. So yeah, worth being aware of those different preferences. I mean, your classic kind of moonshot fund, I think Blackbird really try to position themselves as that sort of moonshot fund, right? They're not interested in anything that is selling to Australians only, as a general rule. They're not interested usually in sort of solid 1s and 2s. There are other funds that are much more focused on, you know, just a good earner. And a lot of angels will be more in that sort of good earner bucket as well. But again, their preferences will vary. The interesting thing is the economics of fund returns in the US suggest that the top performing funds actually have the highest number of losses. So the highest loss rate is the top performing funds, which is a sort of function of the fact that they're taking higher risk. They're going for more moonshots. More of those moonshots fail, but a couple of them come off and they pay orders of magnitude more than funds that are going for more conservative returns. That goes to the nature of venture capital, which is we're investing in what we call convex options. So, you know, uncapped upside, you've got a capped downside and an uncapped upside. So when you've got an uncapped upside, you're trying to get as big an uncapped upside as possible, because that's actually what's really going to limit your returns.
And
awesome.
Just adding to that, I think most angel investors, well, at least it's certainly the approach that we take is that moonshot. You know, if it is only an Australian market, we're not really interested. I mean, maybe if it's an Australian market while they're testing things out, but the ultimate plan is tackling a large global market. That's okay, but we're definitely up for the moonshots, because investing as early as we do, there will be an awful lot of companies that don't make it. And even if they do, they'll make such moderate returns that it's not particularly meaningful.
Fair enough. And Mike, quickly, what's your average and equity?
So 2 to 3 million is our sweet spot. Sometimes we'll go higher, sometimes lower. So the most we've invested 16 million. And the least is 250 grand. But 2 to 3 million is the sweet spot. Like Chris said as well, probably as a rule of thumb, the whole round size could result in up to 20% dilution. Not always, it really depends on the context, but it's quite common for it to be that amount. And obviously we, as a co-investor, don't take the whole of that round. So our 2 to 3 million, might be half of it, or it might be a third of it.
All right, we are coming to the end, so I'm going to try to get in as many as I can. Simon, can you explain the difference between a safe note and a convertible note?
Well, typically with safe notes, they're not redeemable. But both of them are a form of, I guess, a form of debt that goes in that converts into equity. But a lot of safe notes aren't redeemable, which means if for whatever reason you can't raise the next round, the investors can't turn around and say, well, pay me the money back, you still owe me that debt. But yeah, other than that, can be quite similar, to be honest. I think some of the key variables to bear in mind with a convertible note or a safe note is there a cap at all on the level at which it will convert, or just a discount. Usually, almost always, there is going to be a discount to the next round, but sometimes there is a cap at the value it will convert, and sometimes there's not. And the discount can also vary. Typical discounts are sort of 10 to 20%. If you're starting to get beyond that, then you're starting to get reasonably aggressive, to be honest.
Thank you. Andrea, do you invest in pre-revenue startups? And if so, what makes them investable?
Yep, I'm going to answer that, but I just want to follow on from Simon for a minute. Just at that early stage end, two things to note about safes or convertible notes. I know there's seems to be quite a lot of effort being generated around having people raise on, early stage startups raising on safes, Y Combinator style. And I just wanted to point out that it's not the same environment at the early stage, and it doesn't affect a venture capital fund where LPs get their tax breaks related to the structure of the fund. But angel investors get the ESIC tax breaks, the early stage innovation company tax breaks for qualifying companies. And even if the company qualifies, if it's on a safe or a con note, they can't. So for some investors, that will decrease the attractiveness of the investment opportunity for them. So you might be cutting out some of your potential investors. So that's just something to think about. And also, one of the main reasons that startups at that very early stage raise on safes or con notes is because they want to avoid the valuation question, because it is very difficult to value a pre-revenue company. And they don't want too much dilution, so they think that a C note or a safe will avoid that question. And while technically it does, and the others on the panel might disagree with me here, I think in practice it doesn't do a great job avoiding it, because then the cap, and there normally is a cap, not always, but normally investors want to see a cap, that will get fixed in people's minds, including future investors. That's the value that they raise, valuation they raised at then. The other guys on the panel might not agree with that, but that's certainly what I've seen at the early stage end. And I just wanted to make sure that people know it's not the fail-safe way to deal with the difficulty of valuing a company.
I think it's a good point, Andrea. I mean, founders do need to be aware that there's different environments. So in an extremely heated market, founders are more likely to be asking for safe notes because they've got competing investors and they can kind of set their own terms.
Yeah.
And it's a lot more common in the US. I mean, they really originated out of Y Combinator.
Yeah.
It's a less heated market here because there's less funders in this market. And obviously at this particular time, it's less heated as well. The other point that Andrea was sort of alluding to is, I think founders, sometimes they get very fixated on if my valuation is just as high as possible, then I'm winning. And that's not always the case, because ultimately the business has to grow into the valuation. And the valuation you achieve is basically the expectations you're setting. If you do not grow into that valuation, at some point, the chickens will come home to roost, and it may end up in you doing a down round. And there's nothing that kills the company faster than having to do a down round. So, I think founders should be a little bit wary of being too aggressive about wanting to set the valuation too high, too early.
Look, I couldn't agree with you more, Simon. I have what I call my valuation coffin speech that I trot out quite often. And it's because I've seen now two really great, what I thought were great investment opportunities, and we just couldn't go ahead with it because they had these great founders that were, you know, really charismatic and really able to sell their business, and they'd sold it to angel investors at pre-revenue. One of them was an 8 million valuation. It wasn't medtech or anything like that, so there was no justification for it whatsoever. And you know, and I offered to speak to the existing investors to say, look, you know, try and nicely suggest that they're more likely to lose their whole investment if they don't accept a down round, and they wouldn't, and the company died. And I thought that was really sad. And there was another one, it was a similar sort of thing. So what Simon said about, you know, if you raise a certain valuation, then people kind of psychologically want to see roughly a doubling of it in maybe 18 months or so. And if you haven't grown not only into that valuation, but then past it and maybe double it, it's, you know, that's where you want to be to raise your next round. And you've got an awful lot, you've got to grow into it as well as the growth that you need, on top of the growth that you need to reach that next valuation inflection point. And I think it really does add in a very significant level of risk that's already there for the founders. So anyway, I won't go on about that, but it's, you have to think very carefully about it and balance that with your dilution. Oh, sorry, I didn't even answer your question, Cheryl. What was it? Sorry.
You know what? I don't even remember at this point, but this is all very good information. I've been taking notes. We are coming to the end of our chat here. Guys, I just want to say, like, I can't think of another event where we've gotten so many questions that have come through, and I'm so sorry that we haven't been able to answer all of them. But my promise to you all is that we will go through all of these questions and we will group them up and put them to the speakers as well as some of our other partners, and we'll start to put them out and send them out on our blog or something to help get all this stuff answered, because I love that you guys are answering questions. Look, there's one last thing. I know we're a little over time, but I do just want to touch on it. Could each of you just share a little bit around what you think the sentiment around our current environment and how that has affected your fund, as well as you know, what you see in the future for Australian investment? Mike.
So for us, we're still very much active. We have a dedicated fund with capital, and the current environment hasn't changed that at all for us. So we're still deploying capital. We're still providing follow-on funding for our existing portfolio as well. So it's not all doom and gloom. In terms of the environment going forward, I mean, I think, you know, this COVID environment will pass, and I think the Australian venture capital ecosystem has probably never been as strong as what it currently is. There's more participants than ever, there's more funds than ever, and I think the maturity of the ecosystem has lifted significantly in the 5 years that I've been doing this. So significantly both in terms of the investors, but also the quality of the startups coming through. So I think the future is looking good. We're just got to get past this COVID hump, hopefully this year, and things should start turning around.
Excellent. Simon.
I'd agree. I think there's more money around than there ever has been. I think there's probably a little bit of trepidation at the moment. Pre the end of JobKeeper, I think particularly if you're looking at ventures that are that could have some reliance on it, then markets in particular that could have some reliance on it, then there's a little bit of trepidation around that. Yeah, there's more money sitting in the wings to go into ventures than ever. So I think ventures should be getting out there now. They should definitely be getting out there.
Excellent. Chris.
Yeah, I mean, you know, as well as putting on the happy face of we're definitely still deploying, I guess at the end of the day, the practicality is our 10-year life of the funds has not extended. So we still have to deploy on the same timeline that we always have had to. And a lot of funds are in the same position. So it's the capital might be, I guess, a little more hesitant, but it still needs to be deployed. So it is still there. In terms of, I guess the big thing is valuations, and how they've have trended down a little bit, and it's just because it is valuation is an extension of how much we want to how much we need to take from the company to compensate for the risk, and the risk at the moment is higher than it was 6 months ago, which has led to those valuations going down. As Simon said, we don't know about JobKeeper, we don't know about the US, we don't know about a whole range of markets at the moment, which have, even for companies that are shooting the lights out because COVID has helped them in some way. We've seen, the best I've seen in the last couple of months is a company raising flat after shooting the lights out. So it's across the board, the risk is higher, even for companies doing well. And that is, I guess, why if you don't need to raise right now, I wouldn't be raising right now. I would wait till the risk has subsided and the valuations come back up.
I think I have a slightly different view. I think that I suppose I think that there is a lot of uncertainty still globally. We've got the US and Brazil, the likes, that are just not managing the pandemic very well. I think that's probably going to have an impact on exits, because I think US is a market for exits for VCs. But I think, for me, I'm quite excited about the investment opportunities at this time. These sort of investments are 10 years or, but they're long-term investments, maybe 7 years. And I think they're going to look well through the pandemic. And, what's his name? Ray Gallo, the founder of Bridgewater.
Cavalier.
Yeah, his team did some really interesting research on what were the best investments, during the Depression and in the deepest recessions. And it was really interesting, came up with two conclusions. One, meat and potatoes, your Campbell soups, and the other one was innovative technology that allowed adaptation to the new changed world order. And I do think there will be significant changes in the way our world works, in terms, things like, remote working, or all that sort of stuff. So I think it's a really exciting environment to invest in. That's kind of me. How it's affected us is that we started raising our first formal venture fund early in the year, in February, and we had a really exciting month, and then the pandemic just went whoop, and we really had to abandon it. And we didn't really abandon it. We abandoned it because we wanted to actually focus on supporting our portfolio companies. And we're just, I think they're all in pretty good shape. So we're about to recommence fundraising. But interestingly, quite a lot of those people that we pitched to, followed up with confirmations of their investments. So all digits crossed, we'll do okay raising our fund.
Okay, fantastic. Thank you so much to everyone. I know we went a little bit over. Thank you so much for sticking around with us. So we do have more events coming up. If you didn't receive the guide this morning, you should have gotten early access to it. Sorry, I was a little bit late. We were making sure that it was absolutely perfect. But so it went out, and if you haven't gotten it, you should get it in the follow-up email. We'll also include those 2 books in the follow-up email as well that were mentioned today. And we'll be raising another event, or we'll be raising, look at that, we're raising, just kidding. We will be hosting another event on capital raising, and we will seek to answer everyone's questions via either a blog series or a video series moving forward. So thank you, everyone. You've been amazing. And thank you to our panelists, virtual claps. And if anyone would like to know more about Stone and Chalk, let us know.